Thank you very much, Paul. Really appreciate it. And thanks to the Polsky Center for hosting us. You do such an amazing job and support for the search fund and private equity ecosystem, and just really highly regarded. So thanks for having us. Really appreciate it. So today we are going to go over some live deals. We're going to go over 3 examples, an SBA, a larger SBA, and a conventional transaction. We're going to hopefully share hopefully some nice observations with you. Housekeeping, please type your questions in chat, and then Heather's going to, kind of manage the chat flow. But we love interaction. It makes us make sure we're talking about the things you'd like to in the order in which we should talk about them. So please speak up. We really appreciate that. So Live Oak Bank, we are the nation's #1 SBA lender and the nation's #1 USDA lender. But what Heather and I do in the ecosystem of Live Oak Bank is we serve the entire search fund ecosystem. So whether you're going self-funded and choosing the SBA route, or you're going traditionally funded and needing a conventional non-recourse debt, or you're one of these hybrids with you're maybe a little bit of a mix in between independent sponsor, fundless sponsor. We handle the whole spectrum of search fund. That's 100% what Heather and I do. We're co-directors for our sponsor search fund team. So we can handle all breadth of questions along the way here. So before I start sharing the slide, just wanted to talk a little bit about some of the things that we'll be talking about. So we're going to go over live deals. We're going to show you a product matrix where we're getting into some pretty good detail around the differences between an SBA and a conventional deal. So we'll talk about that. And then at Live Oak, we also have different verticals at Live Oak. We're definitely industry agnostic and geography agnostic, but if you happen to find a deal, we might actually have some really good industry expertise. So we'll talk a little bit about that as well. So Heather, with that, would you like to kind of chime in with some comments?
Yeah, so nice to have all of you here with us. And like Lisa said, please go ahead and ask us questions along the way. Lisa, why don't we just jump to the slide on the verticals? I always like to just show you what the verticals are that we have. I think it's a couple more pages. There it is. So these are our current industry verticals. We are adding verticals all the time, but there's a few of these that are usually of particular interest to our search fund clients. Those are the broadband businesses, educational services or preschools, government contracting. We've seen a lot of searchers interested in that, home care, HVAC and plumbing contractors. That's been something searchers have really been interested in, as well as restoration and remediation. So, but there's 30 altogether. And when you bring us a deal and we happen to have a vertical for it, you get that extra domain expertise that Live Oak is so well known for, and can really be helpful in structuring and pricing your deal. In many cases, we might have even seen that deal before and have some insights for you. So I just wanted to highlight that. But great to have you all here, and look forward to talking through these deals with you.
Great. So why don't we, do we want to go over our product matrix, Heather, go into a little bit of detail on sort of the three kind of buckets of lending that we are usually deploying when we're working with our search clients. And this will set us up then for the slides that we'll show you on actual real live deal structuring. So why don't we delve into this a little bit? Did you want to start with
I'll start with the first column. Yeah. So the self-funded searcher, as Lisa mentioned, you're almost 100% going to use SBA. It's the better debt vehicle for most self-funded searchers because it gives you more leverage. And frankly, most of the self-funded searchers are generally going to be looking at slightly smaller deals. So it will fit. So first thing to know about the SBA 7A is that the maximum loan size is $5 million. You're going to generally work with a structure that looks like this. You're going to do 10% equity. That's the minimum that SBA requires. Your equity can come in part from you, the CEO searcher, and your investors. So, at Live Oak, we're very accustomed to and comfortable with the investors putting in the equity. So you're going to get 10% equity. 15% of the deal should be a seller note with a 5-year amortization or longer. If you go with a shorter amortization than 5 years, you're generally going to mess up your debt coverage ratio. There is somebody needs to mute. We require a 1.5 debt coverage ratio for these SBA deals. So going back to the structure, 10% equity, 15% seller note over 5 years, and then 75% SBA financing, which is going to be a 10-year amortization. There is a little footnote there. On occasion, you might buy the real estate with the enterprise. If you do, and the real estate is valued higher than the enterprise, so that's generally going to be something in the West rather than the East. But if that happens, you can actually finance both the enterprise and the real estate over a 25-year term. So occasionally we do that, but most of our deals are strictly the enterprise, and they're going to be a 10-year amortization. So basically that structure will get you to that 1.5 debt coverage if you're paying a multiple between 3 and 4.5. And really that's where most of the companies that fall into this size range are priced. They're almost all between 3 and 4.5. There may on rare occasions be reasons you want to pay more than 4.5 for a company this size, but for the most part, you're gonna be in that range, and that will mathematically get us to the 1.5 debt coverage that we need. So when you follow that structure, you're getting about 4.25 times EBITDA in debt, and that's one of the appealing factors of going with the SBA program is that it's a lot more leverage. And the maximum total debt to EBITDA, if you have the seller note included, is 5 times. There is a subordination agreement we put in place with the seller. And so it basically says if your debt coverage ever falls below 1.5, we can suspend payments to the seller until cash flow improves. Well, that's important because that becomes a lever of sort of cushion on your cash flow that we may need to pull in the future. So when you look at it that way, the more seller note, the better. The other thing about a seller note is it's probably your only recourse if there were any misrepresentations in the deal. So that's one of the reasons we like it. I get asked a lot, does the SBA require a seller note? No, technically the SBA program does not require it. We just require it as a bank because it's really a good practice. And I think most sellers of companies in this price range expect that they will be carrying, around 15%. But if you can get more, all the better. The downside to an SBA program is that you've got to give a personal guarantee for anybody that owns more than 20%. And actually, let me clarify that. It's anyone who has a greater than 20% economic benefit. And the difference there is that we have to factor in preferred returns to their economic benefit. And we still need to maintain that whole economic benefit below 20% in order for your investors to avoid having to give a personal guarantee. So generally, what that means is you've got to keep your investors at 13 or 14% direct ownership or below so that you don't trip up that 20% economic benefit threshold. So that's your, basic SBA program in a nutshell. Maximum loan size in this first column is 5 million. That's the most that the SBA will do. But I don't know if Lisa, you want to walk through the next column. We also offer a program that will take you up to 7.5 million of debt.
Right. And I'll actually say I'm working on right now where we're actually doing 3 million on our junior. So we're kind of scoshing that one up a little bit. So so that's one thing at Live Oak that we're really proud of is that in serving the search ecosystem, we know that our searchers on the self-funded side too, doing SBA largely, are finding larger transactions. And those ones might be where we are doing maybe a little bit more SaaS that is still at the nascent stages, but SaaS is going to get a higher multiple. So we've got a way to take down a little bit larger transaction with maybe a little bit bigger multiple, because we can take our Live Oak $5 million SBA and we can pair it up with a Live Oak junior conventional loan. 10-year am on the amortization on the SBA, and then a 7-year amortization on our Live Oak Junior. And it allows us to get into a company that maybe has had a really nice growth pattern. Sustainable growth, of course, but maybe a larger growth pattern, which is getting it into a larger multiple, or it's an industry that is just being driven by larger multiples, like in a SaaS company. So it's been a really exciting product for us, and it's allowing our searchers to get into maybe a little bit more professionally run company. Again, largely using that big foot forward of $5 million worth of SBA, which is still covenant light, as Heather mentioned. We've got covenants around the seller note, but you're getting into maybe a $5 million plus a $3 million junior conventional, all covenant light. The big issue here is we still need to make sure that we're backing into a debt service coverage that works. So we still want to be around that 1.5 minimum. So what that means is in our kind of smaller SBA or more just general SBA, where we're doing kind of 10% down and that 15% seller note, in the deal sizes that we're utilizing our SBA junior combo, it's generally taking upwards of 15 or 20% equity, plus maybe even 15 or 20% seller note to make that project work and fit into that debt service coverage. But it's allowing us to do 8, 9, even $10 million deals, largely using that SBA debt. But again, those aren't likely 10% down. Those are going to be more like 15 or 20 down for the most part. Very exciting for us and for our searchers. And what we find, that whole economic benefit discussion that Heather was bringing up, we find that in our SBA for our searchers, we're still bringing in investors, even though it's an SBA transaction. I mean, these are definitely fueled by investor support. And what's very exciting about that is that there are even more investors out there backing self-funded SBA searchers, more investors that have really picked up this mantle more than ever. And we've seen an increase even over the last 6 months of really smart investors coming in and kind of having finally figured out that SBA is a really, really good tool here, and putting models together that benefit the searcher, who's definitely going to put their personal guarantee on the line, but bringing some really good investment dollars in from an equity standpoint to get into some larger transactions. And we love that path. We love that a lot.
We do have a question about how debt service coverage is calculated on the SBA and the SBA junior.
Yeah. So basically in an SBA world, it's we still want to get at the EBITDA of the company, but in SBA, let's just be really simple about it. It's net income on the tax return plus add backs that we're going to accept and that you're going to accept that are reasonable. So largely it's sort of officer comp that's got to be adjusted, because we're going to add back officer comp. Then we're going to take out for your salary coming in and any replacement salaries, depending on how the company needs to be operated on a go-forward basis. But it's basically net income plus add backs. That kind of gets you to an SDE, seller's discretionary earnings, in the SBA world. But then we're going to adjust out for your salary and other adjustments that are required. So that's cash flow. That is going to be the numerator on top of our principal and interest on our main term loans for SBA, plus any interest only on lines of credit, and then principal and interest on the seller note. So that's going to be total debt. So adjusted cash flow over total debt, that's your debt service coverage. We want cash flow to cover at minimum of 1.5 or better. And I would say for the most part, Heather, wondering if you would agree, I would say for the most part, our last full year is covering it at definitely better than 1.5 for our SBA loans that we're doing with our searchers.
Yeah, definitely. You want to use the leverage, but you want to use it wisely. You don't want to have no cash flow cushion, for the unforeseen. We have a couple more questions. Do we still require for this junior, and yes, we do. It's the same concept there. We like to see a seller note in those. But as Lisa pointed out, you're probably paying a higher multiple because this is a larger company and you're getting some of your debt amortizing over 7 years instead of 10. So you're going to have closer to that 20%, maybe even 25% equity. Let's see, we have a couple more questions.
And I'll just add on to that, Heather, in our deals that are using our junior debt, we have found that there are a really nice environment of investors out there. There are investors out there that would appreciate getting into a little bit bigger deal. So if it's a doable deal that's larger on the SBA side, we haven't experienced our searcher not being able to find that equity.
And there's a good question on the SBA deal requires. So that's a really good question because there's a big distinction. For SBA,
repeat the question. I think you kind of just cut out just a little bit. So if you could repeat.
The question is what kind of third-party diligence reports we require for SBA deals. In other words, is a quality of earnings required? So it's a great question because SBA doesn't require third-party Q of E, but most searchers still get one. So we recommend it, but we don't require it. And part of the reason for that is the SBA program is very tax return driven. So we always underwrite SBA loans to tax returns. And then we are required by SBA to verify those tax returns with the IRS. And that sort of becomes the diligence that the lender is required to do and does do. But again, I think it's a great practice to get a quality of earnings done. You know, audits are not required, but there is a business appraisal that's required. We do get that, and that is an SBA requirement. And as far as quality of earnings go, I think, you know, we've seen a really nice positive trend in that there are more vendors now than there used to be that are kind of doing Q of E light, kind of a scaled back scope of work that is more cost effective for these smaller deals. So because of that, you're seeing more searchers go ahead and get their Q of E done, even though it's not required for an SBA deal. It is required if you're going to do a carve out, if you're going to buy a division of a larger company, so there's no standalone tax return for us to verify with IRS, then absolutely it would be required. That would be the only third-party verification of the cash flow that you're buying. But otherwise, it's not a requirement, but it is a good recommendation.
And I'll say for getting Q of E's or Q of E lights, especially on our SBA and junior conventional, when we're looking at a larger transaction using SBA, I think recently we have found that, you know, 2020, you know, had maybe some tailwinds, especially with the COVID impacts for the larger transactions. I think our SBA investors are absolutely also wanting Q of E's, just like we would get in our conventional transactions, to make sure that growth that you're paying for in 2020 is supported, sustainable, all the reasons why you'd get a Q of E for our conventional deals.
Mm-hmm. Yeah, there's quite a few questions. I'm trying to get to most of them. Are there rules? Let's see, since we're talking about cash flow lending, and I think I do want to emphasize that Live Oak Bank is a cash flow lender. We actually prefer asset-light deals over asset heavy. And the reason for that is that CapEx can be really difficult to estimate, you know, what it's going to be for maintenance CapEx, what it's going to be for growth CapEx. Obviously, growth CapEx means you have to make bigger investments in order to grow. So all those things considered means we really prefer the asset light deals. And as a cash flow lender, we're not concerned with whether we have collateral. We're concerned with truly, you know, the fundamentals of the financials of the business and whether we have good cash flow coverage. So are we, let's see, assuming we are talking about cash flow lending, are the rules different for asset heavy companies such as manufacturing because of collateral available? So that's sort of what I'm talking about there. No, the rules aren't any different, except that we've got to factor in that CapEx to our analysis. And I will say that on the asset heavy deals that I've done over the years, I've never had the CEO not say something to the effect that after they've closed the deal, the equipment wasn't in as good a condition as they thought, meaning that CapEx is actually going to be more expensive than we prepared for. So it's just really hard, even when everyone's doing their best to be conservative on estimating CapEx. it's very hard to really get it right.
And
Someone else.
I was going to add on to that, and I know this wasn't the question necessarily around working capital, but same kind of correlation when you've got asset heavy kinds of companies, the work in progress, estimating working capital, especially coming into it in a transitionary role as the new CEO, making sure you really understand how that working capital works. And again, asset heavy companies can have a tendency to have some sort of estimating or some other elements of how revenue comes in the door and how it gets cost accounted for. So again, that's another element to why sort of asset heavy companies can be really a lot more complicated than asset light.
Yeah, and there's a couple questions around the personal guarantee. No, it cannot burn off with an SBA loan. They don't allow that. So basically, whoever has to give the personal guarantee because of the 20% ownership from day one is going to keep that personal guarantee throughout the life of the SBA loan until it's paid off. Now, one strategy might be that you grow your company, and 2 to 3 years into the SBA deal, you might be able to qualify to refinance it as conventional and get rid of the PG that way, but you can't have it burn off. There's another question about, and this is a really good one we get asked a lot, is there a high bar for the personal guarantor to qualify? No. So it depends on the bank you work with, but this is why we try to emphasize that we are a cash flow lender. We care and we underwrite to the business, not the personal guarantor. So even though we are required to take that personal guarantee, we're not looking for a minimum net worth or liquidity requirement of the personal guarantor. That's not true for every bank. So you do have to interview your banks carefully and make sure it's a fit for search. As an example, if Live Oak wanted, to be, we are a search fund lender. Most of our clients in our vertical, as Lisa said, are search funds. We wouldn't be doing any loans if we were requiring a big net worth for the guarantor. So we're not focused on that. The CEO needs to bring us their skill set. Their skill set needs to be a good match for the business that they're buying. They don't have to have direct industry experience. Most of our deals, they did not have it. Every once in a while, there might be an industry where we would want, for example, someone that needs to be an engineer to run a certain very technical type of business. That's the exception. But otherwise, you don't have to have industry experience. So it's really a good CEO with a good skill set, great cash flow in the business, good business fundamentals, no customer concentrations, no seasonality, no cyclicality. Those are the things we're looking for. And then the only other thing the CEO really has to bring is just not having bad credit. You have to have good credit. But that's what we're looking for generally. So we probably should, I know there's some other good questions in here, but we should probably move on to the conventional column here and then go into our deal examples.
Great, terrific. And then we'll catch some of those on the fly as we go. So with conventional, and we assume here this is our conventional non-recourse debt, which is what our traditionally funded searchers are looking for. So this is non-personally guaranteed. There's no personal guarantees here. Because of that, and because the way the capital stack works, much lower levels of senior debt. So where we can, have like 4 or 5 times worth of debt on our SBA transactions, we are, 2 3/4 turn senior debt to EBITDA on our conventional. That's our maximum. And where we're doing sort of 75 to 80% financing or 70 to 80% financing under SBA, we're doing sort of 30 to 50% financing under conventional. We'll go 50% of the capital stack when we're the only debt in the transaction. And I would say that for most of our conventional deals, we're probably in that kind of 40% cap stack range. And if you're doing a software company, which enterprise value works on, ARR, and we're still going to look at it from an EBITDA standpoint, but on software, because the multiples are so much higher, we might only be at 25 or 30% of the capital stack when we're doing a conventional transaction. So the deal sets up on that cap stack just much differently. It's a 7-year term versus a 10-year term on our SBA. So these are highly equity focused for lots of reasons. One, just because that's how the the return on the debt service works. You've got to have more equity in there, but that's also how the economics work between the investors and the searcher. So generally, we have, 3 or 4 different covenants that are always going to be on a conventional transaction. And then each one of our conventional transactions is customized with regard to sort of the remaining basket of covenants, where SBA is the only covenant on an SBA is around that seller note subordination. With conventional, we're going to have maximum turns of EBITDA. We're going to have on total and senior, we'll have maximum debt on the cap stack. We'll have a minimum fixed charge coverage. And then on any given deal, depending on the nuances with that deal, we could have a liquidity, a current ratio. Then there's also other financial, and then non-financial covenants as well. So those deals just work a lot differently. And I would say our board of directors, our advisors, knowing who our investors are, really critical on our conventional transactions, because obviously there's no kind of backstop on that personal guarantee. More and more on our SBA transactions, especially on the larger ones, more and more the board of directors and the board of advisors are also important on our SBA loans. And because of the niche we play in, most of our SBAs will have some amount of investors. So board of directors are more and more conversations we have on our SBA transactions, but absolutely on our conventional transactions, we'll get into who the sponsors are.
There was one good question, Lisa, I'll jump in with about a business that just had a recent spike last year. So we'll address the COVID headwinds and the COVID tailwinds that we're all seeing. So if a business had some COVID headwinds and actually had a downturn because of shutdowns, we're able to underwrite those usually on a trailing 12 or a run rate analysis, I should say, and we sort of cut off the bad quarter usually. And those are businesses that have fully recovered and, where their industry is reopened and things look good. It's actually a little bit easier to underwrite a COVID headwind story than it is a COVID tailwind story. So to your question, what if we have a business that saw a big jump in earnings because of COVID? Well, that one gets a little tougher to figure out where's the normalized revenue going to be. And you do see some sellers out there trying to sell on a multiple of 2020 when we know 2020 was, a huge year for them. So I think those are challenging. And with any deal, it's just a matter of how much debt can this company support over this 7 or 10-year term of the loan program that we're offering. So I think that's a good question, especially relevant question, for what we're doing today.
Great. And that's one of the reasons why Q of E on conventional in particular is so important, because those are full Q of Es, and with our service providers out in our ecosystem, they're going to help get to the bottom of sustainability. So 3 other comments in conventional. One, you'll see earnouts. Kind of recently, because of this sort of COVID tailwind issue, we've seen more covenants or more earnouts in deals in the last 6 months than we have really in a very, very long time. So it'd be interesting to see if earnouts as part of the structure kind of burn off and aren't quite as prevalent in deal structures as this whole COVID tailwind kind of gets digested later this year. But that has been a way for these tailwinds to maybe be isolated and put on an earnout. So we've been seeing those more. You can't do an earnout in SBA. You can do a reverse note in SBA, but not an earnout. And then another aspect that is very prevalent in conventional is rolling of equity, where the seller is going to roll some equity as part of that capital stack, and you can't roll equity in SBA. You got to do the 100% buyout. So earnouts and rolling equity are 2 things we see. And then one of the things we really key in on our conventional, even more so, is the investment thesis. What's the plan for the company in later part of 2021, 2022? Where's the growth headed? How are you going to pay for the growth? Are you expecting that to come out of cash flow? Are you expecting more debt? Are you going to bring equity to finance to capitalize the growth strategy? And that's really important because we also want to make sure that we're not necessarily putting the maximum amount of debt on that can be afforded. We might do that in maybe more of a value company or more of a steady Eddie company. We might put higher levels of debt on because that can be supported and we have a pretty good idea of how that's going to grow. But a lot of times the investors on our conventional deals really want that growth story. So we may opt to not put as the maximum amount of debt on in favor of a more sustainable level of debt that allows that growth to happen. So sometimes we'll see a J curve, where your acquisition EBITDA is actually planned to go down. So we may base our senior debt on that investment EBITDA and what's going to be happening in the next 2 years. So it's always a conversation, and the debt is absolutely customized on conventional.
And I do want to jump back to a question on, because you touched on it briefly, the earnout question for SBA. So SBA has some rules. Some of them are counterintuitive, quite honestly. But the rules for an SBA transaction as far as eligibility are that the seller can't roll any equity. And that includes if you even have a key manager that maybe the seller's given 5% to, you have to buy them out too. So you have to end up owning 100%. That's the first one, no rolling equity. Second one is no earnout or any other form of upside to the seller. So you can't get around that one. You can't give them warrants. You can't do anything that gives them upside after the transaction. But what you can do is what we'll call a forgivable seller note. So you might do that first seller note, we'll call it seller note A at 15% and start amortizing that right away. And if you have a particular risk you're trying to solve around, you might do a seller note B that goes on standby for 1 to 2 years. And it has to have a metric that's tied to something the business has already done. So maintaining trailing 12. I saw a creative deal where 2020 was a down year because of COVID, and the forgivable note was tied to returning back to 2019 revenues. Well, that's not an earnout in SBA's mind because you're tying it to something the company has previously done. So that's the key to the forgivable seller note on the SBA side. It just can't be tied to growth. Any type of growth metric then triggers the SBA to think of that as an earnout, and you can't do an earnout with an SBA.
Okay, great. Should we head into our slides?
Sure.
I'm just looking at our time here. We've got basically 20 minutes left, and we want to. I think it's working well for us to do the Q&A as we go, so we'll keep peppering that in. Okay, so our first case study is on SBA, an SBA structure. This was a digital surveillance company. They installed and maintained security systems for like hospitals, assisted living facilities, police departments, things like that. So think, in COVID times in 2020, they did very, very well. They were already on pace for doing, really, really good things. 2020 treated them really well. We closed the deal in December of 2020. Just kind of quickly, some of the things we liked. One of the largest customer was on a contract. They definitely served essential businesses. We had a nice seller note, 20% of the deal with that backstop, that debt service coverage subordination backstop that Heather talked about at the 1.5, where we could maybe turn that seller note off if debt service went below our minimum standards. We had, 15% equity and minority owned, which is a mission of ours. So that was, particularly nice. Great institutional investors on this one. Some of those SBA investors that I was talking about that are now really prevalent in the market. We had some really smart equity on this one, and lots of market opportunity for growth. So, going into competitive pricing, adding on various other digital thermal cameras, all this kind of fancy stuff that the seller just, he was tired. He just wanted to sell his company. So on this one, we actually started out with an SBA plus our junior debt on this one. we were going to add on another 500,000 of our junior. But what happened is when we got the Q of E, this was definitely a Q of E deal, full Q of E, because the financials were a little bit funky, you know, lower middle market. But everyone assumed that everything was going to kind of work its way out. Buyer seller got along great. So we got a Q of E on this one. When the Q of E came back, there was a little bit of softness, a little bit of this kind of moved around in a way that the buyer just really wanted to renegotiate. So we kept the price the same. And then what happened is the seller took more of a seller note. We reduced the need for our junior debt. Seller took more of that risk on, kept the price the same. So that's just one example of how these deals start out one way and sometimes they migrate and look a different way. So we did our $5 million SBA loan. Then the second column there is our line of credit. So we did a revolver, which was conventional because we busted through our SBA dollars. Seller, you know, took a nice seller note. And then we had a nice amount of equity in on this one. The multiple, you know, a little bit higher outside of that standard, but the growth on this was amazing. The investment thesis was very strong. 6/30/20, we closed it at the end of December. So for this example, we don't have that year-end number, but 2020, before we closed, they were well above 2-to-1 debt service coverage. So you can see the nice growth pattern. And then they were already on a good growth trajectory even before COVID. And that really took off, which we think, they think is sustainable just because of, you know, hospitals and just hospitals having to upgrade all their digital surveillance, which they think is going to survive past just this COVID bump. But even if it doesn't, very, very nice deal. So I'm moving on to you.
Sorry, I was talking and I was muted. There's a good question about add-ons, a few questions actually about it. And so I'll before I go into my case study, I'll just address that real quick. You know, sometimes you may come to us with a roll-up strategy, and we talk that through from deal one. And what the cadence of the deals is really important to us. You know, how many of them you might do in 1 year, or maybe it'll take you 3 years. It is tough if you bought a business and you come back to us within 6 months and you want to buy another one. A lot of times credit doesn't like that. They would rather see you get through a little lengthier transition. Not to say that it can't be done, but if it is going to be done that rapidly, it's something you kind of want to prepare your bank for from the get-go. We want to know that you are planning to do another one in 6 months. You know, for those more experienced roll-up operators, we will also even provide a delayed draw term loan. So we set up sort of a big enough credit facility for them to do several deals in a 12 to 24 month period, and then just set covenants around the parameters for each deal. So add-ons is definitely something we support from a financing perspective. It's just something we really need to understand your plan for that from the beginning. Another really quick question on SBA is everyone's heard that the seller has to exit the business within 12 months as far as any key role. And that is true. The question was, could they stay on in a diminished capacity? I mean, technically, I think you'd be in a gray area for something like that. So really your best bet for SBA eligibility is to have a business that you're buying where you can have the seller fully exit within 12 months. That's really the way the rule is designed.
And I'll say observationally on that, I know it sounds good in theory to have your seller, they want to hang around, but I think ultimately, if you talk to CEOs in that chair now, the impetus once you get in there is to get the seller, sort of on their way.
Yeah. All right. So I'll jump into this case here, and let's see, hopefully can answer some of your questions as well along the way. So this is a case where we used SBA, fully maxed it out. So if you look in that left-hand column, you'll see total SBA loan, 5 million. Next column, companion loan, 2.3. So this is where we fully maxed out our SBA, added on our little companion loan piece. We had a little bit smaller seller note here than the 15% we typically recommend, but there were, we felt comfortable. We had a really good CEO here for this business, just a great matchup between his resume and skill set and the company itself. This company had both a COVID headwind and tailwind at the same time based on two of its sales channels. They basically manufacture harnesses that employees wear in warehousing environments. So the tailwind that they got is that one of their customers is Amazon. So that was a big one. And the headwind that they got was that one of their sales channels was musicians and music schools. And obviously that's something that contracted during COVID. And so it was a little bit of work to determine what the normalized revenue levels should be. This company also had a pretty big improvement in their margin back in 2019, because of some lean manufacturing they put in place. So they'd already done some work. The seller had done some work to professionalize the business and improve the margins. And our buyer was pretty excited about that because it really gave him a head start on, getting to his growth thesis. So I know a question was in the chat about that the SBA limit is 5 million at any given time. That's correct. So if, for example, if you had a $2 million SBA loan and you wanted to come back and get another one for 3 million, you'd be at 5 million at any given time. You want to pay them off or pay one of them off, it frees up that money again. But that's basically the way that rule works. And that's, again, why we have this companion loan program, because there are some really nice deals just above, the size that fits easily into that $5 million SBA that can still take a little more leverage. This is a good example of where you need more equity to make this deal work. So you can see in 2019, we got to a debt coverage of 1.88 and about 1.82 was the run rate for 20. And so that required, I think this was closer to about 20% equity, the equity of $1,950,000 here, to kind of get us to that comfortable debt coverage ratio. And I will address debt coverage a little bit here. We've had people ask us, they'll tell us that other lenders say that they can have as little as 1.25 debt coverage on an SBA deal. We just don't know why you would want that. That's kind of our answer to that, is you really do want at least 1.5 coverage. Most of our deals look more like this, 1.8, 1.7, somewhere in there. That gives you sufficient, cushion for the unknown, for one thing. Things can go wrong for temporary periods of time, hopefully. And also, you have the cushion from the seller note, as I mentioned before. So we could, let's just say you depleted your cushion somehow on the original cash flow coverage that we had going in. We can always shut off that seller note and give you more cushion. And those are the kinds of things we look for as lenders to make sure that, you can easily make your payment for the life of the 10-year loan. Another nice feature about SBA is there's no prepayment penalty. So you can pay down or pay off early. Most of our SBA clients do. If you pay a large chunk down, you can get your SBA loan reamortized. So that's another, we'll give you a lower payment, going forward from there. If you want to flip to the next slide, Lisa, I'll just kind of talk through a little of the particulars on this company.
The next slide. Okay.
There you go. Customer base was highly diversified. So I saw a question in the chat about customer concentration. So every lender's different slightly on this, but we look at anybody that represents more than 20% of sales to any single customer as being a concentration that would concern us. If you want to buy a business that does have a concentration, the lender is going to usually do a downside analysis that says, if you lost that customer, how much would that take away from your EBITDA? And would you still have enough cash flow left to cover the debt? In the cases where you wouldn't, that's sort of the no-go sort of decision that the lender would make. A customer concentration might be a case where you would want that forgivable seller note, and you would tie that to retaining the customer for 2 years. If you lost the customer, the seller note goes away and the deal price is sort of right-sized for you. That's an example of why you might want to use that. I did want to touch on that. This company had a highly recurring revenue base. But I did want to point out, I know the search fund model really encourages us all to look for recurring revenue. Obviously, we all know why that's a good thing, but it comes in many shades of gray. So it doesn't have to be contractually recurring revenue. There aren't very many small companies that actually have that. But we analyze, and you'll analyze the company, and you'll find a lot of companies do have recurring revenue, and the data that the seller is able to provide does support that. So this one had that. Their competitive advantage was really high quality, and low to moderate pricing. So it was, positioned them well in their marketplace. Very diversified product portfolio. Again, they focused on lean manufacturing in 2019 and substantially improved their margins. Had a great management team with R&D in place. I'll touch a little bit on transition when I talk about the management team that you may inherit when you buy a company. It's very important that you get to meet those key employees before you close. It might happen just before closing, kind of just depends on the seller and their comfort level with that. But it is important. It's a part of the underwriting that we undertake is, do you have any key employees that you really need to retain? And then what is your plan to retain them after the close? I think can be pretty important. This company also had plenty of room for added capacity. They had a very large facility, and the buyer was not going to have to make a lot of CapEx investments for growth. And that's something we've already touched on. We like that. We like when you can grow without having to spend a lot of money. So it was just a really good sponsor in this transaction. As Lisa said, we are big believers in the search fund model, in particular, the types of investors that you have access to in this model. A lot of serial search fund investors who have just tremendous experience with small companies, and they add a lot of value by sitting on the board. And they add value during the transaction. They add value beyond that, and we, the lender, just think that that's a big important part of the model, the search fund model.
Great. Yeah, we do nice deals.
Mm-hmm.
One other thing on the 1.5 minimum debt service coverage for our SBA stuff too. It's not just necessarily just from the downside, but also if you have any chance or hope of growing your company, you're going to need some margin to grow the company too. So I think we've got basically 5 minutes left. So we're going to speed through the conventional example. So this was a deal where we had partner CEOs, partner searchers. They had complementary skill set, which was tremendous. This was a rural internet service provider. We have an entire broadband vertical, by the way. Heather walked us through our verticals that we have. Broadband is one of them. So this was a rural ISP provider. We have a whole skill set around rural, which obviously, as you can imagine, during COVID, this whole industry just really exploded. We closed this deal March 10th of 2020. So before we all sort of realized or just decided, yeah, this is a global pandemic is when we closed the loan. So luckily, we had a really good industry. We had great partner CEOs. And we like the partner search, by the way. I know there's always questions out there about the partner search. We think it's pretty successful. We think our partner CEOs, searchers, have a tendency to really find deals because you've got that sort of sharing of duties and then also complementing each other's skill sets. So we like that. This one has low customer concentration. The largest customer, I think, was maybe 10%. Customers were on that 3-year auto renews. So as Heather talked about, I know with the methodology, we talked about recurring revenue. This had that a nice recurring revenue stream. Although we're also used to just looking at more predictable revenue streams too. We don't necessarily require that they be recurring, but more predictable. That's how we're going to look at it from the lender. But this had that recurring, low customer churn, very small customer churn. Company been around for 25 years. The length of customer was 10 years plus. The searchers did a customer survey on this one and just got glowing remarks on their customer survey. So that was great. The seller was rolling equity here, which, is just a really nice added benefit to our conventional transactions when you can have the seller rolling equity, which, really kind of helps ensure good transition, but then also helps ensure your investment thesis because the sellers will buy into that aspect of the deal structure. So that just usually bodes very, very well. And in this case, the seller was rolling equity and also doing a seller note. So that was like, wow, that was just really, really good support from the standpoint of the seller liking the CEOs coming in as well. So this one had 2.5 turns of EBITDA, and with regard to the growth strategy on this one, there's a growth strategy, but this one is really more one of those stable businesses. The staff was already professionalized. So, and the seller had already spent some dollars on infrastructure building, knowing that he was going to try to be exiting in a few years. So this one didn't have like that huge growth strategy. Like some of the SBA deals actually we showed on our 2 slides before. So we felt comfortable giving more debt on it because we felt like, oh, this is kind of how it's going to look. And it's a little bit more, a lot more predictable. So we were at 2.5 turns of debt. And the 2019 is where we left this last when at closing, we were at about a 1.7 debt service coverage. Well, in 2020, obviously they achieved much greater debt services than that. And we're hoping ultimately that we can help our CEOs here build by acquiring more rural competitors in their market. So we would love to do some more debt for these folks. Any
questions? I think we answered all the questions unless anybody has any more. We invite you to link in with us. We'd love to, chat with you, understand about your search, talk to you about, let's do the pre-LOI work real quick.
LOI, we're happy to talk with you pre-LOI. We have a certain methodology for how we like for you to approach us pre-LOI. Please email us. We're happy to give you our work papers. We have due diligence questionnaires. We have a cash flow template. So if you've got a pre-LOI deal, you need to be far enough along on the deal to have us weigh in. But if you can fill out our due diligence questionnaire and have completed a cash flow mock-up, we're happy to chat with you. And normally with our searchers, we might look at maybe 2 or 3 deals pre-LOI until you find the one. It allows us to create our relationship with you. There's a lot of debt out there. We think we've got the best debt, but it allows us to create that relationship with you and really get to know each other as we help you look at pre-LOI. But we've got a roadmap for you to follow on LOI, pre-LOI. So email us and we're happy to share our roadmap with you.
And one last good question about working capital. We do spend a lot of time with our searchers analyzing what is the proper amount of working capital that business is going to need and what structure. It depends a lot on what working capital you're buying, if any. I mean, once in a while, the seller won't sell you any, and we have to make up for that with some debt or some additional equity that goes into working capital. And then, we always provide a line of credit, and the size and structure of the line of credit totally depends on the cash cycle of that business and your growth plan. So we take all of that into consideration to make sure there's the right amount of working capital available for the business at close. And that's it, I think.
Thanks for having us. I know that was a lot of material, and we basically put a 90-minute presentation into 60 minutes.
I can't thank you two enough, Lisa and Heather. Absolute wealth of information, and we're so excited to have such great partners at the Polsky Center. So thank you guys. We look forward to doing another one of these soon, and thank you everyone for taking the time out of your lunch hour to join us today. And please join us for some more events at the Polsky Center in the next month or two.